Hello and welcome to another Escala Partners interview with the fund managers. My name is David Bruty and I am an investment analyst in the Escala Chief Investment Office team. Today joining me on this podcast is Justin O'Brien. Justin is the portfolio manager of the Cooper Investors Brunswick Fund, which is an all-cap Australian equities fund that we have recently added to the Escala approved product list. Hi Justin, and thank you for joining us today.
Hey David, great to be here to talk.
Justin, maybe if you could start with a bit of background and history of Cooper Investors.
Yeah, sure. So Cooper Investors was founded 24 years ago by Peter Cooper, who is still our Chief Investment Officer. Peter's aim when he set up the firm was to create an enduring investment business, having started in the market just before the 1987 crash, and then seeing really the challenges of working for institutional managers where the ownership was often held by large offshore groups. So today, Cooper's manages around $8 billion across both domestic and offshore funds. All of the funds invest on the one platform using the same investment philosophy and process, and the business remains privately owned by Peter and some of the investment staff. Initially, we managed money for mostly large institutional clients, but over the years, we've added a range of private clients, mostly family offices, high net worth individuals, and small institutions. I am the portfolio manager for the Brunswick Fund. I've been at the firm for 9 years, working closely with Peter. As the Chief Investment Officer, Peter is responsible for managing the investment team and ensuring at the fund level that we implement the firm's investment philosophy, process, and value. So Peter remains very connected to the Brunswick Fund and is still a large investor in the fund. In addition, I've got all my financial assets essentially in the fund.
So you've got a dedicated team of 3 which manages the fund. Could you give us a bit of a background on each team member and just also talk about the broader Cooper Investors team which you leverage off?
Yeah, so in addition to myself, the team includes Stuart McLaughlin, who is Deputy Portfolio Manager. I've worked closely with Stuart now for over 6 years. And Gordon Lee, who is a research analyst and has been on the fund for nearly 3 years. Prior to Cooper's, I spent more than 10 years working firstly in management consulting, then in stock research for Credit Suisse in London, and a boutique firm in Melbourne called Diogenes, who specialise in earnings quality analysis, which is a little bit like forensic accounting. So when a company reports a profit, it includes both a cash component and an accrual component. But the accrual component is more subjective and therefore it's prone sometimes to manipulation, either in a conservative way or a aggressive way. So earnings quality can provide an interesting lens on a management team and company culture. And it was at Diogenes that I first met Stuart. After this, Stuart went back to work for Deutsche Bank as a small cap analyst, where he had previously worked as a REIT analyst. At that time, I was working at Cooper's, and over a few years, Stuart did a number of research projects for me. Stuart now leads investment in what we call the reversionary capital pool within the fund, and he manages some of our biggest weights in the fund. Gordon joined more recently, having spent nearly 4 years with Wesfarmers in their corporate development team, which has provided a fantastic network for Gordon. At Wesfarmers, he was involved in the acquisition of the pharmacy retail group Priceline, which was quite useful when we were analysing Sigma, which has been a recent addition to the fund. And Gordon's doing a lot of work on our compounding capital pool. But look, a key strength of Cooper's relates to our size and capabilities. We have a 20-person investment team that the Brunswick Fund is able to leverage. And we have significant support also from the rest of the non-investing part of the business by way of data analysis, market access and dealing, back office, and client relations.
Your investment philosophy is built on what you call the VOF framework to analyse companies. Can you give us some detail on what this stands for and how it works?
So the firm's investment philosophy and system, as you said, we call VOF. So V stands for value latency, O for operating industry and strategic trends, and F for focus management behaviour. The VOF integrates both qualitative and quantitative data into a score that we can then use to compare and contrast opportunities across stocks. So it combines really both fundamental views of the economics of a business as well as behavioral observations. And it was the father, really, of value investing, Ben Graham, who was famous for framing two things that impact stock prices, one being the weighing machine and the other being the voting machine. So the weighing machine is all of the fundamental factors that drive prices over the longer term, essentially the economic earnings of a business. However, in the shorter term, it's often the voting machine or the sentiment, market sentiment around a stock that can dominate. And what we really love about listed markets is that when there's a divergence between these two machines, you get opportunity. There's incredible volatility or variation in stock prices. We saw it again this reporting season with company results. And there's empirical research that shows that volatility has increased over the last 10 years, but we embrace it. So as active investors, it's the chance to buy or sell when conditions are most favorable. Ideally, when you see, well, we can see asymmetry, so more upside than downside potential. And the broad way we frame these behavioral attributes of stocks is through what we call hubris to humility cycles. So people get really excited about a certain part of the market, which then leads to hubris. And there are actions and behaviors that can cause problems following that down the track. At the humility end, you get capital exiting, which then sets up a more profitable future. And the interesting thing we think about these hubris to humility cycles is you can see them at many levels. So you get at the economy-wide level, you get them in terms of regulation, you can see them at the company and industry level, and you can also observe them in people and the way they behave over time. Peter often reminds us of the large miners who couldn't spend enough shareholder money when commodity prices and asset values had peaked just prior to the GFC, but when the world was on sale, not long after that, they were not in a position to buy. So it's the proprietor or the owner's mindset that seeks to do the opposite to that. So when we look for and rank management teams, we look for evidence of that proprietorial behavior, such as being a counter-cyclical investor, or more generally thinking longer term about investment. And we also look for this nuanced or deeper industry knowledge that sometimes goes actually against conventional thinking from, say, business schools. And when I started at Cooper's, I did quite a detailed study of Reece, which is the plumbing distribution business that's backed by the Wilson family. And look, it's just a small example, but Reece tend to hold high levels of inventory, which the textbooks might say is actually quite inefficient. But I went on a mystery store tour, and I did it with a person who used to work at TradeLink, who is Reece's main competitor. And on that tour, he said to me that the main reason the plumbers would switch from TradeLink back to Reece was that they were going to TradeLink and they couldn't get all the products they needed. So they then had to go to the Reece store. So why go to two stores when they can just go to Reece? The natural question that I then asked him, well, why couldn't TradeLink just stock more itself? And the problem at that time, TradeLink wasn't making much money. So TradeLink's parent didn't want to invest more. So it was a sort of a chicken and egg or catch-22 situation that was really favourable setup for Reece. It's a small observation. We made a whole bunch more of those that built up into a view and explain why Reece earned the bulk of the industry profits in Australia. But that gets to the other key idea that we have at Cooper Investors, which is observation, not prediction. So we spend a lot of time gathering facts, data, and observing trends that help us understand opportunities and create this VOF score that we use when selecting stocks. And we do this mostly via wearing out the shoe leather on the road. So visiting companies, competitors, and seeing industry experts. And as I said before, the output's both qualitative and quantitative. And it's not an easy task actually bringing those two things together, which also makes it harder to disrupt with machines. So it needs a systematic approach from the team and a standardized set of values, language, and process.
Justin, in my view, a point of difference with the Brunswick Fund is just the structure itself. It's very much unconstrained with a mix of large, mid and small cap companies. Can you talk to why the fund was originally set up this way, the market you were targeting with the fund, and then explain what this means for the fund characteristics like stock and sector weightings.
Yeah, so the Brunswick Fund is incredibly fortunate in many ways because of this flexibility that allows us to really push into areas and find opportunities that perhaps are more difficult for other funds to access. So we can invest across the small, medium, and large cap ASX stocks and then up to 25% internationally. It was a deliberate strategy. We saw that funds with institutional clients in particular tend to have constraints around things like size, industry, and region. So as a consequence, the fund can look quite different to the ASX 200. The index has become quite a concentrated bet on the big five banks. The Brunswick Fund is far more diverse and focused in areas like aged accommodation, where we see strong tailwinds from demographics over the next 5 years. More recently, we've increased the exposure to smaller cap stocks. These stocks haven't attracted the same flows from passive money, and so they have more attractive VOF attributes at the moment. But we tend to lean into lower risk stocks at the smaller end, often that are asset rich or where there's recurring revenue, for example. And then the fund can also invest up to 10% into private opportunities. So around 12 months ago, we bought into the private round of funding for the Mexican fast casual chain Guzman y Gomez. The significant benefit to investing pre-IPO is that there was four of us that were able to spend 5 weeks doing very detailed due diligence. And our big advantage is we were able to bring two members of our global team, so Jeff DiFelice and Marcus Gazzardi, and they brought very detailed knowledge of the best quick service restaurants globally, which are mostly in the US. So GYG's been a strong stock performer, and we think there'll be further opportunities to cornerstone both high quality IPOs and pre-IPOs over the next few years.
Something which I think is also worth expanding on is just the fund's allocation to international equities. You can hold up to 25% there. So can you just talk about how this is utilised in the fund and maybe give some examples of international stocks that you've held in the past?
Yeah, so that flexibility we have to invest up to 25% internationally really links to the fact that Australia has a number of companies like CSL that are essentially global companies. So as part of doing research on those companies, we have to look at their peers and essentially the global comparisons to them. The beauty of the Brunswick Fund, though, is we can then ask the question, which of those two stocks is the better one to own? And we've done that numerous times. So some recent examples being Xero and Intuit in the accounting software space. We actually own both stocks. Macquarie and Brookfield in infrastructure asset management, Transurban and Ferrovial, toll roads, Reece and Ferguson in the plumbing distribution sector. And the most recent one has been James Hardie and Louisiana Pacific, both of whom make siding for housing in the US. And at times we can actually get a bit of an advantage in some of these offshore stocks. Louisiana Pacific's a good example. It's a $5 billion market cap company, which is actually small in the US context. It's a small company with limited coverage. The opportunity we saw in Louisiana Pacific was for it to shift some of its product mix from its historical, more commodity base to a more higher returning product that was much closer to James Hardie's product. And in doing so, create quite a bit of value latency. We watched the stock for quite a while, and then following a soft quarter, the stock was sold off pretty hard, and we were able to pounce on it then at a pretty attractive price. The other one that was interesting was Ferguson, which we started looking at after Reece acquired a US business. Our global team had bought Ferguson in one of their funds, and what stood out was the valuation. So Ferguson traded at 12 times price to earnings multiple when we bought it, whereas Reece and many similar businesses in the US traded more like 20 to 25 times. So that sort of discount you would normally associate with a lower growth, a lower quality business. And that didn't reconcile to our view about Ferguson. The only thing that explained it was Ferguson was listed in the UK, which was just an odd quirk of its corporate history. So not long after we bought a large US activist fund called Trian, bought shares and then put pressure on the board and management to shift the primary listing from the UK to the US. In the years that followed, Ferguson re-rated from 12 times to 20 times and also grew its earnings pretty significantly. So it was quite a good contributor to the fund over that period. The other area that we think is interesting in this international space is that it opens up opportunities in more niche areas that can be good fishing ponds for active investors. One of these areas is spin-offs, which is when a larger company decides to demerge and separately list a smaller division. Spin-offs are good for two reasons. Firstly, they tend to perform poorly post the spin-off, as the parent shareholders often elect to sell their shares. So you get a chance to buy at quite a good price, but it's not just about buying cheap. Secondly, the spin-off can then benefit from a refocusing from the new management team, as the demerged company was often treated as a bit of an orphan child within the parent. Going back in time, we made good money in GrainCorp following its spin-off, but as I said, the opportunity set is quite limited in Australia. So having that opportunity to go offshore is helpful. We bought ESAB, which is a global welding equipment business backed by Mitch Rales, who founded Danaher, which is a large $150 billion market cap company in the healthcare sector. So ESAB was spun out of a larger group and did that typical thing of derating, but was quite a good investment following that over a pretty short period of time.
Looking at the composition of the fund, you build the portfolio from three different investment pools, which you class as compounders, reversionary, and real assets. Can you give some colour on what the characteristics are of the stocks in each of these pools, what the turnover is within each pool, and why the fund is set up this way?
So the three capital pools are a way we like to group the opportunity set, primarily to help us compare and contrast stocks. They're quite different. We've demonstrated this quantitatively via a correlation factor, which is really a statistical measure of the way that the three pools move together over time. Having three pools helps diversify the fund in terms of the sources of value latency. And that's important because we know that the three pools work differently in different market conditions or backdrops. So as you said, the first capital pool is compounders. In essence, these are companies that are growing, ideally organically and ideally at high rates. We look for an underlying product or service proposition that's a significant improvement, such that the company can grow, well ahead of industry rates and win share or penetrate a market. So in the fund, some examples at the moment are GYG, Guzman y Gomez, Mainfreight, and Sigma. And we prefer holding these stocks longer term. There's been examples such as CSL that we held for nearly 20 years. And just a little bit more background I thought might be helpful. A stock that I did a lot of work on when I joined Cooper's was Xero. Xero sells accounting software in the cloud to mostly small businesses. And it was a much better product. It was a step change, really, from the desktop solutions available at the time, such as MYOB. And it seemed inevitable to me that the market was going to switch over to that over time. It was just a question of how long. And I vividly remember going to XeroCon, which in Melbourne at the time, which is the convention they hold for all their accounting channel partners. And it was like going to a music festival. There was thousands of people there, and it was absolutely clear, without having to build a spreadsheet, that the sheer scale of what Xero had already built was not captured in the share price. It seemed inevitable that they'd just create a much larger business in a shorter period of time. Peter and I, on that same day, then met the founder, Rod Drury, and his energy was unbelievable. So all I then needed to do was really build the spreadsheet. The neat thing you can do with Xero is break out the sources of value. So there was geographical sources being Australia, New Zealand, UK, US, the core product, ecosystem revenue, which is what they get from their preferred partners. There was pricing, and then some other blue sky. So I could easily get to a $70 valuation. The shares were trading at 25. So that's where we had clear value latency, strong industry operating trends, and an A grade founder management team, so a high VOF score. The second capital pool is what we call the reversionary pool. So a really fundamental observation in markets is the idea of mean reversion, which is underpinned really by our capitalist economy, where competitive forces see capital move in and out of industries. So some sectors are more prone to cyclicality, driven by the particular industry factors, and therefore they're more prone to this reversionary force. And then at the company level, there are situations where a business gets into trouble and it requires a turnaround. And then sometimes the two are working together, both the industry and the company. Our hubris to humility cycle is really helpful in understanding this capital pool. Regis Healthcare in the aged care sector is a good example of where we've had success in this pool more recently. And then the third capital pool is a little more esoteric. We call it the real asset and income securities pool. In essence, it's more asset heavy stocks that can demonstrate a lower correlation to broader markets. It's a lower risk pool, but interestingly, it's our best performing pool now over the last 10 years. The real asset pool is composed broadly of three kind of subcategories. Firstly, family backed holding companies like Washington, Soul Pattinson, and News Corp, where we can see an asset discount or a valuation anomaly, but where we can also see over the longer term growth in that asset value per share over time. And Coopers has a lot of proprietary knowledge around these family and founder companies. So Alan Goldstein runs a global fund that specializes just in these family and founders. The second subcategory is royalty companies. So we invest in cyclical resource companies in the reversionary group, but royalties are a much higher quality exposure to commodities, given they take none of the operating and investing risks. Their claim is on the revenue of a mine, with a free option usually on expansions. We have a pretty strong view that the duration aspect or the long time horizon of these royalties is often underappreciated. And again, we can open up the opportunity set here by including many of the global royalty companies. And then finally, in this real asset category, we look for asset rich stocks, particularly where asset value is underappreciated. So for more than 5 years, we've owned what we think is the best exposure to affordable housing in Aspen Group. Aspen's got a really strong management team with skin in the game. They've demonstrated an expertise buying assets in distress at a low cost, with the ability to then reposition those assets over time. And so with building costs up 40 to 50%, maybe post-COVID, it's extremely difficult now constructing affordable housing. So with their low-cost acquisition model, Aspen's been able to still serve this affordable housing segment and still grow its earnings at 20% per annum over the last 5 years. But it is a small cap, and it still trades on a low price to earnings multiple of 14 times, despite asset backing and track record. And then separate to Aspen, we also like growth infrastructure, and the New Zealand stock Infratil has been a standout, we think, in this area over the last 10 years.
And if we just look at these three capital pools, how have the portfolio weights changed over time, and what is the catalyst for change, and where do they sit today?
So broadly, when we're allocating capital, there's both top-down and bottom-up factors involved. So I spoke before about the backdrop influencing how each of the pools perform, but there's also the bottom-up part of it that's important, and in particular where we're actually seeing latent value across each of the pools. At the moment, the fund is positioned roughly evenly across the three pools, but with a slight skew towards the real asset pool. But over the longer term, the fund is held close to 50% in compounders. So we'd expect to get back there at some stage. Now, we had been increasing our exposure to compounders about 12 months ago, but a lot of them significantly re-rated. So again, we've reduced the weight towards those. But I do think if the current correction that's happening as we speak continues, there will be some opportunities that arise in that compounding pool.
When we're considering new funds for our APL here, one of the things we look at is how they perform in different market conditions. And something that stood out with the Brunswick Fund was how it has been less volatile than the market despite having this bias towards mid and small cap companies. Can you talk to just how the fund has performed in different market conditions?
And so the fund does have a long performance track record for the industry of over 21 years. I think the best description of that is the tortoise over the hare approach. So with that lower risk profile. And look, it's interesting when you look at active funds, just how hard it is to deliver consistent performance over time. A couple of years ago, the Brunswick Fund was featured in a Morningstar report, which identified just a handful of Australian funds that had delivered 5-year outperformance consistently over a longer 15-year time period. And as you said, the fund has this, we think, relatively rare trait of combining both good performance and lower market volatility. When we've analysed the fund's outperformance over the 21 years, the thing that stood out is the fund tends to do better in down markets. So it largely keeps up in the up markets and then doesn't fall as much in the down market. And that's really important for us, that down market attributions. We don't want clients giving up after a big downturn. There's numerous studies that point to the risk of being out of the market on the best days, and the best days often come after the worst days. But look, downturns are a part of investing in stock markets. I remember still the last recession we had in Australia, growing up in Geelong, which is not too far out of Melbourne, but we had the Pyramid Building Society there collapse in the early 90s. And then when I started work, I started not long after the dot-com bust. And then I was in London at Credit Suisse when the global financial crisis hit. And I will never forget walking out of Credit Suisse down to the Lehman Brothers building and seeing people walking out with boxes in their hands because, it was a real shock that a institution that had been around for 150 years could all of a sudden go bankrupt.
If we just look at 2024 for the Australian equity market, we had a significant concentration in returns among the largest cap companies, particularly the banks. Despite not holding any of the major banks, the fund's returns were still quite strong. Can you just expand on what drove the fund's performance in 2024?
Yeah, so the really pleasing thing about 2024 was there was quite a diverse attribution across the capital pools, size and region. So Regis Healthcare, Guzman y Gomez, Sigma and Aspen were our top performers. And in this group, you have a mix of small, medium and large cap companies, and they go across each of the three capital pools. So that's really what the fund is set up to do, deliver broad performance across each of those areas.
And we're recording this podcast amidst a pickup again in volatility, not only in the broader market, but also significant individual stock volatility through February's reporting season, which I think you alluded to. Do you have any thoughts on the current market conditions and how you're sort of navigating it? Is it throwing up new opportunities for the fund? And just further to that, you are joining us from the US as part of your extensive travel and company visitation schedule. So do you have any anecdotes or observations from your trip that you can share with us?
Yeah, look, it's no doubt we're in a much more uncertain environment now. So despite the fact that interest rates are back to, a more reasonable level, we now have this unstable political backdrop. I guess before this recent pullback, stock markets had a pretty good run. Now, look, the key observation was a lot of the performance had come from the very large cap companies and that the small and mid caps had actually trailed. So that difference between small and mid caps remained. So there's no change really from our perspective in terms of how we're thinking about that opportunity set. But look, it's been an interesting time to be in the US. We've met companies across the portfolio and watch list stocks in a range of sectors, so including mining, fintech, restaurants, transport, media, data centers, renewables, and consumer. So quite a broad set of observations. We don't always go that broad, but it just happened that way this time. And the feedback has been varied, but clearly uncertainty is pretty high at the moment. I think it's hard for companies, in particular, interacting with government at the moment. That was a key form of feedback. But the US is a very large, dynamic market. And I think often a bit of a downturn is helpful for the better companies to, for example, make acquisitions or win market share. And looking ahead, we invest over the 3 to 5 year time frame, and we're pretty excited about the opportunities ahead for our portfolio companies. And I think if anything now, the valuations look even more attractive.
Thanks, Justin. On that note, we might leave it there today. So thanks for your time in introducing the Brunswick Fund today, and we'll see you again soon.
Great. Thanks very much for your time today, David. Good to speak.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. Escala Partners is a corporate authorized representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.